Friday morning, 8:30 a.m. Eastern. The U.S. Bureau of Labor Statistics drops April non-farm payrolls. Gold is at $4,570. Silver is at $73.88. The dollar index is at 98. The 10-year Treasury yield is at 4.44%, its highest since July 2025. And the Strait of Hormuz is still a war zone. One number on Friday morning can gap this entire market 2 to 5% before most retail investors can react. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. The NFP print, the weekend Hormuz situation, and the structural setup underneath all of it. That is what this video covers. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. The U.S. Bureau of Labor Statistics. April non-farm payrolls prints Friday, May 8, 2026. Consensus estimate sits at approximately 60,000 jobs added. That is down sharply from 178,000 in March. 60,000 versus 178,000. That is not a mild slowdown. That is a labor market decelerating at speed. The Federal Reserve left rates unchanged at its most recent meeting. Its most divided decision since 1992, per CNBC reporting from April 29, 2026. The Fed is boxed. It cannot cut into 3.3% CPI. The highest reading since May 2024. It cannot raise into a labor market losing momentum this fast. That paralysis is the setup. And here is the unusual detail that deserves scrutiny. 3 separate binary events are converging on the same 72-hour window. NFP on Friday. University of Michigan May inflation expectations. Same morning. And a live military confrontation in the Strait of Hormuz that does not pause for a U.S. data release. The timing. The timing is what deserves scrutiny. Think about what that sequence actually means for a market already sitting on gold at 4,570 and silver at 73.88. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time the Federal Reserve was this divided on a rate decision while CPI was above 3% and oil was above $100 per barrel simultaneously, gold was in the early stages of a sustained repricing higher. That is not a prediction. That is a historical data point. The data is already telling you something. Let's build it out. Now let's build the full picture because the NFP gap risk does not exist in a vacuum. The U.S. Bureau of Labor Statistics. April jobs report lands against a backdrop of escalating macro stress across 3 simultaneous inputs. First, the Federal Reserve. According to CME Group FedWatch data, 94.9% of market participants expect rates to remain unchanged at 3.5 to 3.75% at the June meeting. Rate cut probability for June stands at 5.1%. The Fed is effectively frozen. Second, the U.S. Treasury market. The 10-year yield at 4.44 to 4.46% per trading economics data is the highest since July 2025. It moved 5 basis points higher in a single session on May 4th as Hormuz escalation drove oil prices above $100 per barrel. Third, the Shanghai Gold Exchange. Physical silver benchmark morning fix sits at $82.11 per ounce per SGE official data. COMEX Western spot at $73.88, $8.23 premium, 12.8%. Asian physical buyers are already positioned ahead of Friday's number. The rate of divergence between physical Eastern pricing and paper Western pricing is not narrowing. It is compounding. The ones who said the SGE premium was noise, they are not saying much right now. And here is what makes that picture even harder to ignore. COMEX registered silver, the only metal deliverable against a futures contract, stands at 77 to 80 million ounces per CME Group daily warehouse data. Total paper claims across all delivery months represent 550 to 575 million ounces. Coverage ratio 13 to 14%, below the 15% stress threshold for 6 consecutive months. The World Silver Survey 2026, published by the Silver Institute and Metals Focus, projects the 6th consecutive annual deficit at 46.3 million ounces. At the same time, gold holds support above $4,400, while the dollar index sits at 98 and yields sit at 4.44. That is not a contradiction. That is the setup. A physical market structurally undersupplied, a paper market holding above key support despite macro headwinds, and a binary event arriving Friday morning that forces a resolution, at least on the short-term tape. Setups like this can take time to resolve fully. What this tells you is the structural picture. The timing of the resolution is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not treating as the primary variable right now. 35%. That is the share of global seaborne crude oil trade that transited the Strait of Hormuz in 2025, per the International Energy Agency. That strait is now effectively closed by the US-Iran conflict because this is no longer a backdrop. It is the primary variable. U.S. forces repelled Iranian attacks while escorting 2 U.S.-flagged vessels through the Strait of Hormuz, per Reuters, reporting dated May 5, 2026. The UAE intercepted Iranian cruise missiles and attributed a major fire at Fujairah port to an Iranian drone strike. Brent crude sits above $100 per barrel, up more than 50% since the start of 2026. The World Bank's April 28 Commodity Markets Outlook projects energy prices to surge 24% in 2026, the largest annual energy price shock since Russia's invasion of Ukraine in 2022. Here is the math that makes this unavoidable for metals investors. Saturday and Sunday markets are closed in the West. Any military development over the weekend, a Hormuz escalation, a ceasefire signal, a new strike on Gulf infrastructure, reprices on Monday open before most retail participants can act. 2 to 5% gap moves in either direction are the documented historical range for this type of binary weekend risk. Markets are still pricing a contained, near-term resolution to the Hormuz situation. Look at DXY at 98 and tell me what probability you put on that assumption. When markets stop pricing containment and start pricing a prolonged closure, gold reprices upward. Silver reprices upward with leverage. That is the historical pattern. It has not been different yet. Gold Western Spot at $4,570. Silver Western Spot at $73.88. Shanghai Gold Exchange, Silver Morning Fix at $82.11. $8.23 premium. Here is the short-term read. If Friday NFP prints below 40,000, rate cut expectations reprice immediately. Dollar weakens. Gold targets 4,750 to 4,800. Silver targets $80 and above. If NFP beats at 100,000 or more, Fed hold narrative firms. 10-year yield pushes higher. Dollar strengthens. Gold tests 4,400 support. Silver tests 65 to 68. That is the only short-term framework that matters right now. As for the weekend, I cannot model what happens in the Strait of Hormuz over 48 hours. Nobody can. I cannot tell you where gold opens Monday morning. If you think you know, good for you. This is a simultaneous convergence of NFP binary risk, live geopolitical escalation, and structural physical tightness in silver. 3 inputs. 172-hour window. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. DXY at 98 creates conventional dollar strength headwind for metals pricing. The 10-year Treasury yield at 4.44%, highest since July 2025, reduces the appeal of non-yielding gold and silver. A NFP beat above 100,000 reinforces the Fed rate hold and pushes gold below $4,400 support. The bull case is equally real. NFP consensus at 60,000 is already a sharp slowdown from 178,000. A miss below 40,000 reprices rate expectations immediately. COMEX silver coverage ratio at 13 to 14% for 6 consecutive months represents documented structural stress per CME Group data. Shanghai silver premium at 12.8% confirms physical buyers are already paying above paper price right now. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. The gap risk on Monday open is real. The structural story underneath it is also real. Both exist simultaneously, and the one that matters to your position depends entirely on your time horizon and your size. Don't take my word for it. Verify every number I gave you today. Check the data yourself. US Bureau of Labor Statistics at BLS.gov, CME Group FedWatch and warehouse data at CMEGroup.com, International Energy Agency Strait of Hormuz, data at IEA.org. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers before Friday. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.